Welcome to the Deep Dive, where we cut through the noise of earnings calls to bring you the essential insights you need to stay well-informed. Today, we're diving deep into Hormel Foods Corporation, ticker HRO, their Q3 2025 earnings call. And what we're seeing is, well, it's kind of a classic corporate squeeze, isn't it? They've served up some really impressive sales growth, but a relentless surge in commodity costs is really putting their profits in a pressure cooker.
Yeah, indeed. And while the headlines might just focus on the immediate financial miss, there's a truly nuanced story here. It's about resilient top-line performance battling some pretty formidable external pressures. So we're going to unpack exactly what happened, why it mattered so much to the market, and what management, including some new leadership, is trying to do about it.
Okay, let's get straight to the numbers then. For Q3 2025, Hormel reported adjusted earnings per share, EPS, of 0.35 cents, which unfortunately missed consensus estimates by about 5 to 6 cents. That's a noticeable gap.
It is, and it certainly got the market's attention in a big way. But here's where it gets really interesting. Revenue actually came in strong, $3.03 billion. That comfortably surpassed the $2.98 billion consensus.
Okay, so better on revenue.
Right, and that represents a healthy 4.6% year-over-year increase in net sales. Organically, they actually surged an impressive 6%. So on the demand side, their products are really moving.
That really highlights the stark contrast, doesn't it? Strong top-line growth, showing real consumer demand, but then this disappointing bottom-line performance.
Exactly.
And the market definitely took notice. Shares opened way down, closed down over 13% on heavy volume the day the results came out.
Yeah, that kind of reaction isn't just a shrug. It signals real concern about profitability going forward.
Okay, so let's unpack this divergence.
Yeah.
With such robust sales, what was the primary culprit behind the earnings miss? I mean, where did things go sideways on the profit front, given all that top-line momentum?
Well, the most significant factor was a steep and frankly unanticipated surge in commodity input costs. We're talking about a massive 400 basis point increase. That's a full 4% jump in raw material costs just in Q3 alone. It's a huge hit.
400 basis points. Wow.
Yeah. Specific pressures came from pork bellies, bacon up about 30% year over year. Then you had pork cutout up 10%, pork trim up 20%, plus this persistent inflation in beef and nuts. These elevated costs basically just absorbed all the margin from that strong top-line growth and the benefits they were getting from their internal Transform and Modernize initiative. It was just a headwind that overwhelmed everything else.
Wow, 400 basis points, that's massive. It really puts their strong sales into perspective, doesn't it?
Yeah.
So even with all these popular brands, they just couldn't outrun those surging costs. But you mentioned strong organic sales growth across the board, so the products are still connecting. Where did the portfolio actually shine?
Oh, absolutely. Despite the margin compression, the underlying demand for Hormel's products stayed incredibly robust. Take the retail segment. They saw a solid 5% increase in both volume and sales. You saw impressive momentum in brands like Holy Guacamole, Spam, Black Label Bacon, Erds, Hormel Pepperoni, Applegate.
Spam too, that's interesting.
Yeah, Spam delivered year-over-year volume and net sales growth. They have some savvy summer promotions, new Spam singles flavors. It really shows the brand's enduring power.
It's kind of fascinating, right? Even when wallets are tight, certain comfort foods like Spam seem almost recession-proof. Hormel Pepperoni also saw over 20% year-over-year volume growth after a brand renovation new packaging. That boldly irresistible campaign shows marketing can still move the needle.
Okay, so consumers are definitely still reaching for Hormel brands. What about outside the grocery aisle? Food service, international, how do they hold up?
Well, the food service segment was impressive. It actually outpaced the broader industry. We saw 2% organic volume growth and 7% organic net sales growth there.
And that was driven by its solutions-based portfolio. Basically, they're not just selling products, they're providing customized offerings to help restaurants and institutions manage menus and costs. Smart play in this environment.
Makes sense.
And international also delivered strong results. 8% volume growth, 6% net sales growth. That was propelled by a thriving China business, retail, and food service, plus global Spam exports. That global demand for Spam is really something.
It really is.
Even Jennie-O ground turkey navigated inflation-based pricing pretty well, capturing dollar share and net sales growth. Planters, though, it saw some top-line recovery in distribution and penetration, but profitability was definitely hit hard by those higher nut costs and product mix. Just shows how widespread the pressure is.
Right. So the products connect, top line is strong, but costs are just eating into profits.
Yeah.
Like you said, a powerful engine, but a leaky fuel tank. What does this mean for strategy now, especially with the leadership changes? Interim CEO Jeff Ettinger, new president John Gingos. How are they planning to plug that leak?
Well, under this new leadership, there's a very explicit, very urgent focus on returning bottom line growth. That's the mission. They are implementing what they call targeted pricing actions to offset commodity inflation.
Targeted. So not across the board.
Exactly. It's a tightrope walk. They have to figure out which brands, which markets can handle increases without losing customers or share. And crucially, they acknowledge a significant lag. They expect these benefits to only partially show up in Q4 2025, stretching into Q1 2026.
So no quick fix.
No quick fix. And that lag really underscores the pressure they're under right now. Retail pricing especially needs a careful approach, balancing costs, consumer reaction, brand health.
Okay, pricing is one lever, but what about internally? You mentioned the Transform and Modernize initiative. How much can that really help against these huge commodity headwinds?
That's a critical question. And the Transform and Modernize T&M initiative isn't just corporate speak, it's their internal fight. It seems to be on track. They had about 90 projects underway in Q3, streamlining operations, reducing waste, boosting efficiency.
And delivering savings.
Yes, delivering incremental benefits. They expect to finish fiscal 25 near the high end of their $150 million incremental benefits range. That's significant. Part of that includes optimizing manufacturing, like partially closing one facility to enhance overall efficiency.
Okay.
But the key insight, I think, is that while T&M is delivering, it alone isn't enough to fully offset this commodity tsunami. It just highlights how big these external headwinds are.
Right.
We're also looking at cost reductions in SG&A selling, general admin expenses, noting those have actually outpaced sales growth recently. So it's a wider cost focus.
Given all these challenges, the cost pressures, the strategic shifts, how do they adjust the financial outlook? I imagine it was a pretty significant revision.
You're absolutely right. The outlook was significantly revised. It's a clear reset of expectations. For Q4 2025, sales are projected between $3.5 and $3.25 billion. Okay. But adjusted EPS is expected at 38 cents to 38 cents to 40 cents. That's way short of the Street $2.49 consensus. Yeah. Organic net sales growth expected at a more modest 1.4%. And consequently, the full-year fiscal 2025 adjusted EPS guidance got cut sharply. It's now $1.43/$1.25, down from the prior range of $1.58-$1.68. That's a serious reduction.
A definite reset. But, you have to wonder, after missing so badly, are they maybe being a bit conservative now? Setting a lower bar they can clear?
That's exactly the question investors are asking now. Management was explicit. Profit recovery is expected to lag into next year, fiscal 2026. Those previous 2026 growth goals they set out back at their 2023 Investor Day. Those were based on assumptions, stable input costs, stronger consumer sentiment that just haven't happened.
The ground shifted under them.
Completely.
Right.
So those goalposts have moved dramatically. They're now pointing back to their long-term growth algorithm, 2-3% net sales growth, 5-7% operating income growth as a more appropriate general expectation. They'll give full 2026 guidance on the Q4 call, but the message is clear. The path back will be tougher in the near term than they thought. Fiscal 26 is shaping up to be a huge prove-it year for this team.
Okay, so the market reacted badly. Stock tanked. What are the key signals for investors now? What should people be watching as we head towards fiscal 26?
Well, that immediate reaction on August 28th was brutal. Stock opened down almost 15%, closed down over 13%, volume way up.
Yeah.
You also saw a spike in near-dated $25 put options, a strong bearish signal. And Hormel's just really underperformed the consumer staples ETF, the XLP, over the last year. This isn't just sector weakness.
So specific concerns about Hormel.
Right. So key watch items going forward. First, price realization versus consumer elasticity. Can they actually get those price increases to stick without losing too many customers? That's number one.
Makes sense.
Second, commodity curve developments. What happens with beef, pork, nuts? Do prices ease seasonally like they sometimes do, or stay stubbornly high? That's a huge external factor.
A wild card.
Exactly. Third, the inflection point for Planters margins. Can they turn that top-line recovery into actual profit despite high nut costs? And finally, the durability of international growth, especially China, global spam, and the sustained impact of those T&M savings. Like I said, fiscal 2026 is really the year they have to prove their pricing power and that the process redesigns are working under this new leadership.
All right, before we wrap up, let's switch gears for our This Is Not Financial Advice segment. Time to get a little audacious, maybe speculative, but plausible. Given the commodity pressures that delayed profit recovery, the big guide down, the market reaction, What's a contrarian play you're eyeing for Hormel?
Eh.
Something for the bold investor.
Okay, for the truly contrarian, or maybe someone betting these macro headwinds stick around and the recovery takes even longer, consider a long put spread on HRL, targeting February 2026 expiration.
A long put spread. Okay, intriguing. Walk us through the mechanics and the thesis.
Sure, the idea is you'd buy the HRL Feb 2026 $20 puts and at the same time sell the HRL Feb 2026 $15 puts. So for anyone unfamiliar, it's a defined risk strategy. You're betting the stock price falls significantly, but selling that lower strike put reduces your cost and caps your maximum profit.
Okay, and the thesis behind it.
The thesis is simple. Management explicitly said profit recovery will lag into next year. This trade tries to capitalize on the market potentially underestimating just how long those commodity pressures and consumer elasticity issues might last, well into early 2026. The stock's already down a lot, yes, from around $29 to $25 after the call. But further earnings misses or persistently high costs could definitely push it lower, maybe below that $20 strike. So this spread gives you a defined risk, you know exactly what you could lose, but offers substantial upside if Hormel's profitability keeps disappointing into early 26. It's basically a bet that while the long-term plan might be sound, the path there is still pretty bumpy, and the market hasn't fully priced in that lag yet.
Interesting angle. So recapping Hormel's Q3, a real tale of two halves. Strong organic sales growth, great brand connection, but completely overshadowed by that huge unexpected surge in commodity costs, led to the EPS miss, the revised outlook, and that big market sell-off.
That's right. And now you've got new leadership laser-focused on restoring the bottom line through pricing and those T&M initiatives. The next few quarters, and especially fiscal 2026, are just going to be crucial. They need to show they can execute against these headwinds and get profits moving in line with that strong top line again. It's definitely a prove-it year.
Absolutely. And remember, everyone, the insights we share today are for informational purposes only, definitely not financial advice. Always do your own research and due diligence. Thank you for tuning into the deep dive. We appreciate you joining us for this deep dive into Hormel Foods.